us now in a CNBC exclusive interview is Paul Vogel, Spotify CFO. So, Paul, certainly the market liked the quarter. Operating profits also good. Users, revenue. What's driving the improvement for you?
Yeah, I think it's a number of things. I think, first of all, we're really pleased with how we did in the quarter, how we executed. As you mentioned, our user growth was really strong, up 19% to 381 million users. Our subscriber growth strong, up to 172 million users or subscribers. And our revenue growth at 27% was really, really strong. I think what's really impressive in the quarter was our advertising growth, up 75%. That was led by really strong growth on the music side. It was led by triple-digit growth on the podcasting side. So we saw advertising growth really help propel our revenue growth even stronger to one of the best revenue growth rates we've had in the last couple of years. And then when you take that down, our gross margin was better than we expected, I think better than the market was looking for. We're at over 26.5% gross margin, which was really strong for us. And as you mentioned, that translated into a bottom line operating profit. This is the third quarter in a row we've had positive operating profit. We have positive free cash flow. So in general, we felt like our top level KPIs, our users and subscribers performed really well. And in this quarter, it translated into strong revenue growth and strong margins.
So on the margin story, talk to us about what kind of improvement we're going to see from here, because this is really what the stock moves on. And you've promised that you could get to in the 30s. It's been in the 20s. I know the music labels are all concentrated and that costs a lot. But are we at an inflection point for you in the margin story?
Yeah, I think we're pleased with how the margins have improved. There's a number of factors that have helped our gross margins. I think one is better advertising, so we get better leverage, both on the music side, but particularly on the podcasting side with better advertising. So that's really helpful. We've talked about our marketplace strategy of giving tools and services to creators and labels, and that's been positive for us. And we've also actually done some things that aren't as noticeable on sort of what other kind of costs of revenue. So streaming delivery and payment fees and customer service, things that people don't really think about, but we've been able to get leverage on there. And so I think we feel really good about the gross margin story. I think we still believe wholeheartedly that 30% plus long-term gross margins is in our future.
So, Paul, it's rare on this quarter, at least, to hear app-based tech companies like yourself talking about great advertising growth. You haven't had any effect of the Apple iOS change?
Yeah, we had a really great quarter. I think for us, what's been really helpful is we have a ton of first-party data. And so the first-party data for us has helped translate into good engagement and good measurement for the advertisers. So they want to be a part of that ecosystem because of the strong first-party data we have. And I think also, podcasts in general are doing really well. We've had great engagement. We've had great growth there. And so as we've had more impressions, the demand has been really, really strong. Our impression growth was significant. It led to better CPM growth as well, both across music and across podcasting. So we feel really good about the health of the advertising business. We've invested a lot in tools and technology in our advertising tech stack. And we think we're only at the very beginnings of where advertising can go for us. It's about 13% of revenue in the quarter. That's up from 9.5% where we ended last year. I think we've talked about, we believe advertising could be 20% plus of our business. And I think Daniel even said this morning, maybe even beyond that. So we'll have to see.
What about prices? I know you somewhat recently took your first ever global price increase. Is this something that you can consistently do over the years, like a Netflix?
Yeah, we'll see. We test pricing all the time. So I'd say in the price increases we've already taken, we're really pleased with how those have gone. So when you take price increases, you're looking at two factors. One, does it impact your gross intake? So do you lose people who might now not come in because of price increase? And does it impact your churn? And so what we've seen in the markets where we've taken prices, there's really been very little impact to gross intake or churn. Everything has been kind of in line to slightly better than expected. So we'll have to see about that. And for us, it's always about testing and learning. We have a number of different price points in the market, from our standard plan, our family plan, our student plan, our duo plan. And so we're always looking at what's the best thing for creators, what's going to grow the most users and most subscribers to grow our business, and what's going to be best for the users that have differentiated products and services.